Here at Prop Firm Ask, we make things easy to understand for everyone. Hey guys, welcome back to another episode. In this video, we will be going through our support and resistance trading strategy in depth and how we use it in combination with price action. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start: everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets. So we're going to go very in-depth in this video. The best trades usually happen around support and resistance. No matter how you see the chart, it will be obvious. Most traders love to use support and resistance as a trading strategy, but they often lack a clear method for taking advantage of price action support and resistance. In this video, I will show you how to build a systematic trading approach using support and resistance. So what exactly is support and resistance? Support and resistance levels, or support and resistance zones as they're often called in price action books, are basically areas in the market where the price has a high probability of reversing and moving in the opposite direction. They are drawn on the chart using horizontal rectangles and are found by looking for the times when multiple reversals occurred from similar points to one another. These areas serve as valuable markers that are fundamental in identifying entry, exit, stop loss, profit-taking levels, and risk-to-reward ratios. Although the steps sound easy enough, many traders struggle to find support and resistance zones in practice. If you are having difficulty, don't be discouraged. Identifying levels of support and resistance is a skill that is built up over time through lots of practice and analysis. There are thousands of ways to identify support and resistance levels on a chart. Some traders will use indicators, but we honestly prefer to draw them ourselves by observing price action. You can learn to decipher what the market is showing you. Our method is simple yet effective and can be adapted to fit into any trading strategy. Step 1. Start with a clean chart. Support and resistance are all about price action, nothing else. Remove distractions and simply focus on the price. Indicators have a tendency to cloud a trader's judgment. This is especially true where a trader has multiple indicators on one chart. A trader can easily convince themselves they are seeing things that are not necessarily there. When it comes to drawing lines of support and resistance, keep it simple and start with a clean chart. Step 2. Identify all swing highs and lows. The first support and resistance indicators are swing highs and swing lows. Swing highs and swing lows are turning points in the market. These are areas that the market has already indicated there is more buying or selling pressure, causing the market to turn. So, if the market were to revisit these areas again, there is always a chance that it could turn at those areas again. So I want you to put a line at every top and low you see on your chart. The important thing here is to draw a simple line of all lows and highs. It shouldn't be very subjective. The powerful aspect of this step is that you will be able to easily determine whether the market is in a trend or not, since you will see the highs and lows. As you can see on this chart, the market isn't currently in a trend. Step 3. Add areas to connect the highs or lows. The last step in drawing support and resistance zones consists of linking the highs and lows you identified with horizontal rectangles. Those will become your main support and resistance zones. There is almost no way that the zones you draw will lie exactly on all the highs and lows you identified. That is totally normal. Be okay with it. Whenever you feel you can connect two highs or lows with a horizontal rectangle, do so. Once you have completed this process, you can be confident that the rectangles represent clear support and resistance zones. Step 4. Simplify. Remove any areas that are not close to the current price. They will only confuse you. If the price does dramatically jump, you can always redraw your areas of support and resistance. But in the meantime, keep your focus on levels that are just a few pips away from current price, and pay even greater attention to levels that have shown strength or levels that have been tested 3 or more times. How to trade support and resistance. One of the best uses of support and resistance is for defining entry and exit points for positions, coupled with efficient risk management settings. Now that you know all the basics, it's time to apply these basic but extremely useful technical tools in your trading. Because here at Prop Firm Ask, we want to make things easy to understand. We have divided how to trade support and resistance levels into 2 simple ideas: the bounce and the break. First, the bounce. As the name suggests, one method of trading support and resistance levels is right after the bounce. Many novice traders make the error of setting their orders directly on support and resistance levels and then just waiting for their trade to materialize. Sure, this may work at times, but this kind of trading method assumes that a support or resistance level will hold without price actually getting there yet. You might be thinking, why don't I just set an entry order right on the line? That way, I am assured the best possible price. For example, instead of simply buying right off the bat, we want to wait for it to bounce first before entering. If you've been looking to go long, you want to wait for it to bounce off support before entering. And if you've been looking to go short, you want to wait for it to bounce off resistance before entering. By doing this, you avoid those moments where price moves fast and breaks through support and resistance levels. From experience, catching a falling knife when trading the market can get really bloody. Second, the break. In a perfect world, support and resistance levels would hold forever. In a perfect trading world, we could just jump in and out whenever price hits those major support and resistance levels and earn loads of money. The fact of the matter is that these levels break, and often, so it's not enough to just play bounces. You should also know what to do whenever support and resistance levels give way. There are 2 ways to play breaks in trading: the aggressive way and the conservative way. The aggressive way support and resistance breakout strategy. The simplest way to play breakouts is to buy or sell whenever price passes convincingly through a support or resistance zone. The key word here is convincing, because we only want to enter when price passes through a significant support or resistance level with ease. The support and resistance breakout strategy involves the following steps. Step 1. Identify the price movement direction. If there is an uptrend, we should expect a resistance breakout. If there is a downtrend, we should expect a support breakout. Step 2. As soon as the price makes a real break through the target level, we open a trade. In case of a resistance breakout, we buy an asset. In case of a support breakout, we sell it. The conservative way support and resistance retest strategy. Instead of entering right on the break, wait for the price to make a pullback to the broken support or resistance level and enter after the price bounces. Placing stop loss properly. When using support and resistance trading strategies, once again take into account that support and resistance levels should be referred to as price zones, which sometimes appear to be quite blurry. The price actively interacts with these areas, so stop loss should be placed outside of these zones. As always at Prop Firm Ask, we want to make things easy to understand. If you learned something new, make sure you subscribe, click the notification bell, and leave us a like to show your support. See you next time. Now that you've mastered the basics of support and resistance levels, it's time to delve into some advanced strategies that can give you an edge in the market. Gap 1S. One technique is using Fibonacci retracement levels. These levels are derived from the Fibonacci sequence and can help traders identify potential support and resistance zones. When combined with traditional support and resistance levels, they can provide more accurate predictions of price movements. Gap 2S. Another advanced strategy involves the use of pivot points. Pivot points are calculated based on the high, low, and closing prices of previous trading sessions. They can serve as a predictive indicator for future market movements. Traders often use pivot points to determine potential entry and exit points. Gap 2S. Lastly, don't ignore the power of volume analysis. High trading volume often confirms the strength of support or resistance levels. By analyzing volume along with price action, you can make more informed trading decisions. Gap 2S. These advanced strategies can significantly enhance your trading skills. Remember, practice is key. Try incorporating these techniques in your demo account before applying them in live trading. Gap 1S. If you found this advanced guide helpful, make sure to subscribe, click the notification bell, and leave us a like. Your support helps us create more valuable content for you. Until next time, now that we've explored advanced support and resistance strategies, let's discuss how to adapt these levels in different market conditions. Gap 1S. Market conditions can vary greatly, and understanding how to adjust your strategy accordingly is crucial for successful trading. Gap 2S. In a trending market, support and resistance levels can provide key entry and exit points. During an uptrend, look for support levels to buy or add to your position. In a downtrend, resistance levels can be ideal for shorting or taking profits. Gap 2S. In a ranging market, where prices move within a horizontal channel, support and resistance levels become even more significant. Traders can buy at support and sell at resistance, effectively capitalizing on the range-bound price action. Gap 2S. Volatile markets require a different approach. Here, it's essential to use wider support and resistance levels to account for larger price swings. Combining these levels with indicators like the average true range, ATR, can help manage risk. Gap 2S. Adapting to different market conditions not only improves your trading accuracy but also enhances your ability to manage risk. Always remember to review and adjust your support and resistance levels as market dynamics change. Gap 1S. Now that we've explored how to use support and resistance in different market conditions, let's delve into some common mistakes traders make when using these levels. One of the most frequent errors is not properly identifying true support and resistance levels. Traders often mistake minor price fluctuations for significant levels, leading to poor trading decisions. Always confirm the strength of a level by checking its historical significance and the number of times it has been tested. Another mistake is ignoring the context of the overall market trend. Support and resistance levels are more reliable when aligned with the prevailing market trend. For instance, in an uptrend, support levels are more likely to hold, while in a downtrend, resistance levels are more effective. Many traders also set their stop-loss orders too close to these levels, only to be prematurely stopped out by minor price movements. It's essential to provide some buffer space to account for market noise. Over-relying on support and resistance without considering other technical indicators is another pitfall. Combining these levels with indicators like moving averages, RSI, or MACD can provide a more comprehensive analysis and improve your trading decisions. Lastly, emotional trading can lead to poor use of support and resistance levels. Fear and greed can cause traders to enter or exit trades too early or too late. Always stick to your trading plan and avoid making impulsive decisions. By being aware of these common mistakes and taking steps to avoid them, you can enhance your trading strategy and increase your chances of success. In this segment, we'll explore the various tools and indicators that can enhance your support and resistance trading. While traditional methods of identifying these levels are crucial, leveraging the right tools can significantly improve your accuracy and efficiency. First up, let's talk about moving averages. Moving averages smooth out price data to help you identify trends and potential support or resistance levels. The 50-day and 200-day moving averages are particularly popular among traders. When the price approaches these moving averages, they often act as dynamic support or resistance levels. Next, we have the Relative Strength Index, or RSI. The RSI is a momentum oscillator that measures the speed and change of price movements. By identifying overbought or oversold conditions, the RSI can help you anticipate potential reversals near support or resistance levels. Another powerful tool is the Fibonacci retracement. This tool uses horizontal lines to indicate areas of potential support or resistance at the key Fibonacci levels before the price continues in the original direction. These levels are calculated based on the vertical distance between two extreme points, usually a high and a low. Pivot points are also worth mentioning. These are calculated based on the previous day's high, low, and closing prices. Pivot points and their associated support and resistance levels can help you predict potential price movements and identify key levels for entry and exit points. Volume profile is another essential tool. By analyzing the volume traded at different price levels, you can identify areas of high buying or selling interest, which often coincide with support or resistance levels. Lastly, don't underestimate the power of combining multiple indicators. For instance, using moving averages in conjunction with RSI and Fibonacci retracement can provide a more comprehensive view of the market, allowing for more informed trading decisions. By incorporating these tools and indicators into your trading strategy, you can enhance your ability to identify and trade around support and resistance levels. As always, practice and experience will improve your skills over time. Thank you for watching. If you found this segment helpful, please like, subscribe, and hit the notification bell for more trading insights. Happy trading and see you in the next video.